Let's talk about today's market action with these gentlemen in today's closing bell exchange. It's Ken Mahoney from Mahoney Asset Management, David Seaberg from Cowan & Company, Brian Evans from Bond Street Wealth Management, and Andrew Wilkinson from Miller Tabak. Good to see you all. Thanks for joining us today.
Thank you.
So Ken Mahoney, we didn't get sell in May and go away, but could we get a June swoon if this picks up here? What do you think?
I know. I still think the path of least resistance is that stocks go higher. I think at the end of the day, you have a lot of money managers that are experiencing performance anxiety. And I'm not referring to performance anxiety that you see on the TV ads or TV commercials, but you have the averages up 13, 14%. Many of those money managers are still behind that. And to keep up with the Jones, they have to buy stocks. So I think that performance anxiety is going to help out stocks in the long run because these money managers need to add to their stock portfolios.
Okay.
David Seaberg, do you agree with that? What's your take here in terms of this market and what we've been seeing over the last 2 weeks? Nervousness. Has anything changed?
No, I mean, look, I do agree. I think we're going to continue to move higher. That's been my thesis all along. Still very bullish in the market. Look, I think, we know what the Fed's going to do, or we have an idea. It's going to be moderate, the way they come and pull QE back. And I think that, the economic data, what we've seen so far, has been improving. One thing that's very important to look at, I know people are concerned about rates, and they're talking about the fact that the 10-year's been going higher, and we've seen that over the past 3 weeks. If you look at the S&P 500, I think there's roughly 400 stocks in the S&P 500 that actually pay a dividend. They pay a dividend that actually roughly equals where the 10-year is right now. So my question to you is, what would you rather have? Would you rather have an investment in the 10-year where you have kind of a relatively still lousy yield coupled with duration risk, or would you rather have the opportunity to be in an equity that's got a yield roughly around where the 10-year is and the opportunity for growth? I'm going for growth.
All right. Well, I'm going to ask Brian Evans to answer that question as well, because that debate has been raging for a couple of weeks now. Do you buy bonds or not? Goldman now says sell those bonds. UBS says buy those bonds. What do you say, Brian?
Well, I think it depends on which bonds you're talking about.
Well, the long-term treasuries, longer-dated maturities.
Oh, the long-term treasuries. I'm not a big fan of treasuries. I don't see any risk-reward with the treasuries. They're an all-time high, but there are other areas of the bond market that you can get into that are secured, select high yields. But the treasuries, which are very heavy in most bond market indexes, are not a good place. You have to be careful about buying just a bond market index to expose yourself to bonds.
Let me ask you about stocks here, Andrew Wilkinson. I mean, we had the GDP report out. We continue to see, economic data that shows an anemic story. Is that enough for this market to be justified? Do you think that we're getting ahead of ourselves in terms of the strength relative to what's going on in the economic backdrop?
Well, I don't think the path for stocks will remain exponential, Marie, going forward. If you look at the pattern we've had so far this year, January, March and May have been excellent months for stocks. They've outperformed bonds, and had you invested alternatively in bonds in February and April, you'd have done very well out of bonds. So the pattern, silly as it may seem, is to go out and buy bonds, particularly with yields ending the month on such a bad note.
So you'd be buying bonds. I mean, are we talking about long-term treasuries as well?
Yeah, I don't dislike the bond market at this point. I think we've had a significant spike up in yield, well, a drift higher, not so much a spike. I think that the Fed has us exactly where they want us. I don't think it was any mistake that Bernanke made when to Congress the other week. I think he wants this debate about tapering out in the open. I don't think the Fed is very close to tapering its bond purchases. I think you need to see 3 consecutive 200,000 per month payroll gains. The earliest that could happen is September, and if we trip up next week, which I would expect, if you're even looking at the Chicago Purchasing Managers Index this morning, the employment component didn't quite rise as much as it did at the time of the January report. That report only produced 148,000 payroll gains. People next week are looking for 165,000. I think there might be some disappointment there.
David Seaberg, I know you're watching carefully, waiting for that payroll report next week as well. What are your expectations?
stocks?
Look, my expectations, I mean, I guess I hope that it's a very good number. I mean, like everybody does, I hope the number is a good number. If it's a weak number, I think you're going to see a sell-off, and I think it will be met by buying. There's still hedge funds massively underperforming the market. They have to catch up. They're going to be there buying the stocks. You have a lot of money on the sidelines. They're going to be coming into the market. So I think, again, pullbacks are a buying opportunity, and you need to take advantage of it. It's that simple. Look, we just had a technology conference that just ended in New York yesterday, and I'm going to tell you something. The tone coming out of that conference was off the charts. So very positive tone. Leads right into the whole thesis. The cyclical rally's on. It's going to continue. People are still bulled up here.
Yeah, well, tech is cheap, right? I mean, was the optimism around technology, though? Because technology certainly has been an underperformer.
Look, it has been an underperformer, and that's why it was so interesting. I think the going into the conference, the concern was the optimism wouldn't be that upbeat. But I'll tell you what, the semi-cap equipment names in particular, and we've been talking about our expectations of CapEx. We're way high in the street, and our sort of conviction is that through this year and next year, it's going to be meaningful higher than what street expectations are. Okay. That's bullish, and I think that thesis was played out.
Quickly, Ken Mahoney, we'll give you the last word.
Yeah, I think it's really interesting for the bond market here. There's been some chatter this week about Fed Chair Bernanke retiring. I don't know if the market's fully dealt with that. We may have a Costanza moment, like George Costanza in a Seinfeld episode, where he leaves on top. He tells a funny joke and he exits. Fed Chair Bernanke will be leaving on top now with the way the economy's improved so much since the Great Recession. So maybe we'll have a Costanza moment with Fed Chair Bernanke.
Well, we'll see how the QE experiment ends.
Exactly,
anyway.
right. Thank you, gentlemen. Have a good weekend.